Tim, it's a great privilege to have you on our podcast series, one of our first series that we're broadcasting at IEL. And as you know, we've been communicating about this opportunity for the last couple of weeks. It's just a privilege for us at IEL to be able to talk about what you and your colleagues have been up to at Terra Alpha, a public equity company that has achieved a number of things from both a financial perspective and a sustainability perspective. Congratulations to you and your colleagues, genuinely. Most of our viewers don't know much about you, so how would you initially describe yourself, Tim, and your colleagues at Terra Alpha? Give a brief introduction, what you're doing, how long you've been operating, number of colleagues that you're working with, just a brief introduction.
Sure. Thank you. And thank you, Terry, for having me on the podcast. Really, it's a real privilege. So as you said, Terra Alpha Investments is a public global equity asset manager, fund manager. We were founded in 2015. So this is our 10th year of operating as a firm, which is exciting. We are 100% dedicated to what we refer to as sustainable and impactful investing. And we do that based on our framework, our philosophy, I should say, for how we invest, which is to invest in public companies that are profitably leading the transition to a truly sustainable economy. In that phrase are two important things. We're looking for successful, growing companies that are profitable, as well as truly sustainable. To us means an economy that is operating in alignment with our natural resource systems, regenerative capacity, and serving the needs of society. So that's sort of our philosophical framework we use. Our outcome goals that we have beyond just is to have three levels of returns for our investors. One is competitive financial returns. Second is sustainable environmental returns, which we can come back to. And the third is very much alongside that real world impact through our corporate engagement and thought leadership work. We manage just under 200 million in assets across roughly 140 LPs in two strategies. Our investor base is primarily, in terms of number of LPs, and high net worth individuals, but we have a number of family offices, endowments, and foundations as well. Some notable investors with us is the Russell Family Foundation, the College of William & Mary, the Surdna Foundation, as well as National Audubon Society as examples. We have a team of 10, primarily based in DC. We have two colleagues who are in Los Angeles area and one in the Midwest who works remotely, as well as 8 advisors. And our team and our advisors kind of make up a combination of people who have high levels of environmental experience or academic knowledge, as well as professional investors who have been investing for decades, in my case, going on 40 years. We have a just really great mix, and I'm happy to talk a little bit more about those, but that's sort of the brief introduction.
40 years, maybe a little bit more about yourself, Tim. I know you spent a number of productive years at Capital Group before arriving at the sustainability mission. What about your background that you've had a lot of experience in is informing what you're doing now?
Sure. So I got into the investment business almost nearly 40 years ago because I became really fascinated with the idea of what makes a great company great. Because to me, that was investing, was finding great companies and investing in them to benefit from their success. So all my investment career, that's what I've been focused on. I was very fortunate to join Capital Research in 1990, at the time when it was a $60 billion asset manager, and stayed there for 19 years. And by the time I left, I had evolved from being a research analyst to a portfolio manager in some of the larger funds. And I was managing 26 billion at that time because the firm was managing 1.2 trillion. So it was an incredible time. But along the way, while I was there, I came increasingly recognizing that the interconnection of the investment business that I was in and the capital markets with the economy and the environment, society, were things that I hadn't really fully understood or considered, and I think most investment professionals hadn't, that there was a connection, that those were interconnected systems. And I increasingly became aware, recognized the role I was playing as a very large active asset management manager at the largest active manager in the world at the time, in terms of driving some outcomes that we didn't fully understand and we certainly didn't intend to create. So I ended up, after efforts to try to change how we were investing at Capital, I ended up leaving and on my own to go work with environmental organizations to build my understanding of the systems that they were assessing and the information sets they had created.
Well, just to pause you there. So what was that? Was there an epiphany there? Was there just something that you that's a very important pivot in your career. So what was it that led you to that desire, that that
Yeah.
interest?
So to go back a little bit in history, before I started the investment business, I was a student at the College of William and Mary, and I was focusing on international relations and the Cold War. This is the 1980s, so the Cold War was very much a real thing before the wall had fallen and the Soviet Union collapsed. I also met this incredible woman who became my wife, who was a planetary geologist and was studying the surface of planets like Venus, which has a runaway greenhouse gas effect. So in my side of my ear all the time was this understanding of planetary systems, but not necessarily thinking about the interconnection. It was like, well, that's interesting, but what does that have to do with investing? That became increasingly, as knowledge and information about the impacts of climate change were becoming increasingly understood and modeled by science community, it was slowly creeping into my head, this understanding of the interconnections. And then the aha moment was really, I was at a conference and this guy named Al Gore gave a slideshow presentation called The Inconvenient Truth. And the penny dropped right then. And that's when I really started the transition of my recognition that I needed to think about the impacts and the abilities to assess the risks of those impacts in investing. That was very leading edge. This is in the early 2000s, 2006, 7, 8, and then 9 when I left Capital. So I felt that there was very little chance that I was going to be able to change Capital, and I wasn't comfortable continuing to do what I was doing anymore. So that was kind of the catalyst for getting me to leave Capital. Then I worked with a number of environmental organizations on a pro bono basis, either as a trustee for the Nature Conservancy in Virginia, or most importantly, I spent a year in London working with the Carbon Disclosure Project senior team to help them think about being more effective in their mission. So that was sort of the pre-Terra Alpha, and then I started considering how could I put this all. Does it make sense to put it all together in one investment strategy that actually tries to make a difference and change how the capital markets think about environmental issues and help to encourage companies and investors to value those resource systems in a way that would lead us to be more efficient with them.
Let's get into that, because as you know, you and your colleagues went through an IAS process. You got an impact authenticity score and scored incredibly highly, Tim, both on your authenticity and your impact. And your impact ambitions are not low. They're described on your website as catalyzing more rapid positive change in our economy, as well as helping to build a more sustainable future for all. With $200 million in capital under management, Tim. These are ambitious goals. Tell me exactly how you and Terra Alpha are promoting those.
Yeah, I mean, they are big goals, but if you really look at and as you have, I'm sure, and many in your audience have looked at the realities of the health of our planet, we need to make some big changes if we're going to continue to have a planet that sustains life on it and in a healthy, vibrant way. So those are what science leads us to recognize that we need to do. And, to us, just kind of investing in lower negative impact companies is just doesn't really accomplish anything in the real world. It may be addressing what investors would like to be part of, which is lower in negative impact. But I think most investors really want the world to be better for the long term. And we feel like while we ourselves won't directly cause all these big level changes, we can be part of the effort to catalyze that, because people will follow what is working. And I think there is a large appetite amongst companies and investors to have the world be long-term sustainable and to be part of that transition. So what does that really mean? So in our case, we were very honest at the very beginning to our investors. We aim to do three things, as you referenced: competitive financial returns, superior environmental returns, and actually help make the world a better place. And what does that mean for us to make it a better place from an environmental perspective? That is, we need to see a reversal of the growth of greenhouse gas emissions to start being a decline as the economy grows. We need to see the reduction in use and impact of freshwater systems, again, as the economy grows. Reduction in waste streams, which are basically the inverse of being efficient with natural resources, raw materials, et cetera. The more efficient we are with those, the less waste we create, the better we are as we grow the economy. And then very specifically, where we have the most ability to make impact, because the others are sort of indirect outcomes, is to get companies to develop and implement much more environmentally efficient business practices and do a better job of disclosing on their impacts and their work. Mm-hmm. And that would help other investors too, because we weren't looking for unique disclosure to us. We wanted public disclosure so that investors can then consider that information as part of their own analysis, which helps to drive companies further and faster, because most investors want companies to be efficient with the resources they're interacting with, whether it's labor, technology, capital goods, financial resources, or people resources, or natural resources.
And as you know, Tim, when we embedded ourselves with your impact team as well as your investment team, your proficiency at those types of both corporate engagements as well as, let's be honest, stock selection, company selection, is really what comes out. And you seem to have two principles that I'd like you to spend a little bit of time on: environmental productivity and enduring business models. These are two, call them investment themes or investment processes that seem almost proprietary to Terra Alpha. What can you tell us about environmental productivity and enduring business models? What do those mean?
Yeah, and they were basically developed to allow our research team to have frameworks for which they need to, as they're doing their due diligence on a company we're considering investing in, that they've considered at the minimum those kind of levels of information. But they really get to the heart of what we're trying to do, trying to find really good companies that are going to thrive in what is already a changing world. And how they use, and that's the enduring business model. And then the environmental productivity is how that company uses and impacts natural resource systems. So we'll start with the enduring business model, because they're both equally important in our process. But most of your audience who's most familiar with this is sort of a very rigorous look at just what the company does and how they operate, so that we understand how they might thrive, knowing the world's going to change. It has kind of three elements to it: a thematic overlay of the business, a quantitative element, and a qualitative element. The thematic overlay is given, we've kind of laid out for our analysts, this is some of the big thematics that are happening in the world. These aren't unique to us. They are well understood thematics around, say, a lower carbon economy, more natural resource efficient economy, changes that are going to happen because of the amount of climate change that's inevitably going to be facing us and already is facing us going forward. Changes to our health systems and health technology, improvements in our food systems, both the health of the food and the health to the planet, how we manufacture the food, and a number of others, demographics and technological innovations, et cetera. So that's the thematic. How does this company fit into that? Which of the thematics might its business or its products align with? And in some cases, those changes are positive or negative. So it's a very complicated kind of process to even thematically map it. Then we're looking at once we've kind of gone through that and we say, well, there is a large amount of overlap with our thematics with this business. Then we look at the business itself, the business strategy, the financial metrics, both current and looking forward, the operational side, which is often with many companies today about, yes, plants and factories, but much more around intellectual property, human capital that's needed to achieve their goals, and then governance and management. We're looking at those pillars, thinking out 5 to 10 years. So we don't do quarterly modeling. We're looking at annual model going out for 10 years to understand how this company might grow in the future. So that's the enduring business model approach. It really allows us to identify and invest in for the long term high quality companies that we think are leaders in the transition to a sustainable world. Then we get to the environmental productivity, which is the necessary condition. They have to be a company that has high level, what we consider environmental productivity. And that has its own 3 steps. The first is the characterization of the company. So what ways does that company, through its products, its value chain, its supply chain, impact and use key natural resource systems? So think about atmospheric air quality, freshwater systems, waste streams, forests, soil health. How does that company's business interact with those systems? And in which is where it has the most material impact? And then from that, is there something they can do about that? Some businesses are kind of locked into that reality, and others, there's a way for them to change. An auto company can change how much its emissions from its value chain is by moving to more electric vehicles. If you're committed to be an oil company, it's very hard to change your resource, your negative impacts on the environment in a material way without being a whole different business model. So we're characterizing the companies first and foremost. Then we look at both qualitatively, how they're thinking, how intentional are they about what they're trying to do to reduce their negative impacts, what their plans are, what their progress is. And then we're quantitatively looking at very much like the history of where they've been and their impacts and related to their disclosure. And that's where disclosure of information is really critical, because as an investor, we cannot really do a proper job assessing a company without the company disclosing where their impacts on these natural resource systems, which is becoming increasingly available to most investors, but 10 years ago was not very available. So the quality of that disclosure is critical to the understanding that investors can have about how a company they might be considering investing in might be exposed to risks or being creating opportunities by how they're managing those resource systems. So those are the 2 frameworks we utilize to understand a company before we invest. I should also point out that as we're doing that analysis, one of the byproducts of particularly the environmental productivity rate process is it helps us to identify not only the areas where a company is doing well, but where they can actually improve. And that helps lay out our planning for how we're going to engage with the company. So it comes out of the research process. We identify specific to that company areas that they can improve that we think would make them a better company and more valued by the market.
I want to come back to that corporate engagement as part of our last piece. But before we do, I always find it helpful. And again, you and I've had our private conversations, Tim. A couple companies, that your process led you to make pretty large investments in. Maybe pick one that few people have heard of. And I always like it when you talk about Adidas, something that everybody's heard of, but maybe didn't know that you saw under the hood. So a couple of examples of a couple of companies that your process, led you to that you're very proud of and your investors are grateful that you found.
Yeah, well, I mean, I'll because you mentioned Adidas, I'll do that one, but then I'll go on to another one. So Adidas, as most people are aware, is the second largest sporting equipment company in the world after Nike, and sell 450 million pairs of shoes a year. So a very large company, not to mention a lot of clothing. That in our estimation was a good example of a company that had a very high carbon intensity because a lot of their materials that they used were polyester, virgin polyester, to manufacture shirts, clothing wear, their apparel that people wear every day, and as well as their shoes. And at the time, we thought, well, there is a way they can change that. You can use other materials, obviously, material innovations. And they had just, after we had invested, they had just started selling tennis shoes, running shoes, using plastic that was recycled, that was being captured in ocean waste by a company called Poly Ocean Foundation. And they produced 1 million pairs of shoes the first year, and every pair sold $200 a pair out the door. Mm-hmm. So then they ramped production to 5 million. The next year, sold them all. 11 million the year after that, sold them all. Exactly. Now, 99% of their shoes they're making are using recycled.
They embarked on a multi-year process, but I think they even met their goal even before they anticipated.
They did. So. They had a goal to get to that level by, I think it was 2 years ago, and they exceeded it. And the thing is, it built the brand. It helps build the brand.
Yeah.
It helps address a real world issue, and the shoes work just as well, and they have scale impact. So it's an incredible example of a company, and it's not that even well understood by people. But they do have the Poly logo on a lot of the shirts. You see a lot of tennis players mm-hmm. wearing their shirts, and it's just a great example of something that worked for the company. That didn't in no way degraded the quality of the product and made it a much more environmentally successful business model.
Do well, do good.
Which is obviously hugely important for a branded company like Adidas.
What's another company though, Tim? Adidas is well known. What give us a diamond in the rough, something that your process led you to that you might not have found if you hadn't been looking for it.
So thanks. I'll talk about a company called Tomra, which is a Norwegian machinery company, and what it got us interested is this issue we were focusing on: waste streams, which is a critical part of how companies can negatively impact the environment, is what they do with their waste. And so we have a couple of different investments in companies related to managing waste, which obviously we hope to see reduce the amount of waste streams. But their focus is really on two things. And it was really the fact that they can enable the transition that makes it particularly interesting. And that is they make reverse vending machines where people can go to the store or local convenience store where they've already, to bring back the bottles and cans they bought drinks in and put it back in the machine. Think for a U.S. consumer, a Coinstar, where you bring your coins in, you get your receipt for your money back. This is the same basic idea, except it's with bottles and cans. And they are a global leader in that business that is increasingly being mandated in countries around the world to improve the amount of recycled material the recyclable material that actually gets recycled, because it's not being thrown into standard waste or on the side of the road. Mm-hmm. The other thing we engaged with the company was they were already doing this business, but what we really wanted them to do is also set science-based targets for their operational impact and their supply chain, because we have found that if companies, even if they're doing the right thing, if they're not disclosing with standardized goals around key environmental impacts, and certainly the greenhouse gas emissions is a pretty key negative impact all companies have. If they don't have standardized commitments and then a validation process, then it's unlikely they're actually going to live up to their goals. So we've been advocating since 2017 that companies set science-based targets for their greenhouse gas emissions, and that's something that we've worked with Tomra over the years as an investor to encourage them to do.
We've come this far in the interview, and we've not been able to talk too much about returns. Tim, I'm going to do that for you. In excess of 9% annualized returns since inception. You had particularly good performance in the first Trump administration. Do you see environmental circumstances coalescing for the next few years that that validates some of the investment themes you're following? Could Trump 2 be as good as Trump 1 for Terra Alpha investors?
Well, I'm going to be very careful
Forward-looking
about making
statements.
any forward-looking statements about our investment returns. I can tell you that we're clearly in a different, there's a number of things that are different,
Yeah.
but there are other things that are similar. So, the market, in both cases, the concerns about the uncertainty created by the Trump administration were very real when the first time he was elected, and the changes that he made, pulling us out of Paris, et cetera, were not constructive on the surface for companies that felt those were important goals. I think what's very different today than back in the beginning of the first Trump administration is companies are in a very different place than they were then. Very few companies had really focused as much on their sustainability reporting, recognized, seen the real impact that the changing world was having on their businesses in terms of, whether it be major storms that have been helped partially triggered by climate change to just heat storms and drought conditions and the impact on crop cycles has been very real to companies. And, there's almost no industry today that you can't identify negative impacts from climate-driven change in our weather patterns or even just day-to-day climate realities. So I think we're in a different place where companies that then were still on the verge of really kind of understanding the impacts, and the investors were much more interested in rewarding those companies for doing that work.
Mm-hmm.
I think it'll be interesting to see how that plays out going forward. I think it's in the best interest of companies to continue doing their work. And I think we're seeing that so far as the companies remain very committed to making it very public how they are working to reduce their negative impacts on the environment, and are continuing to do the work that is required to do so. So that will lead to our portfolio outperforming the market over the next couple of years. It's a combination of us not being static. We're continuing to always reassess companies in the portfolio and circumstances. Obviously, it certainly helped during the Trump administration that we had a period of very low real interest rates, which helped the value of growth-oriented companies, which is our portfolio is fairly growth-oriented. So we'll see where that plays out over the next couple of years.
The other, and this was the final topic that I really wanted to talk about specific to Terra Alpha's business model, is the corporate engagement piece, Tim. And you and I have discussed it, science-based targeting, dialogues that you have. Can you give an example or two of, you don't have to name the corporations because that might be uncomfortable, but you might, examples of where you engage in corporations, you're absolutely sure that you made them more environmentally aware, and it translated into better financial performance. We're an example of corporate engagement, which ended up being a win-win, precisely what it is that you're promising your clients.
Yeah, and well, let me go back and preface what I'm about to say with the premise that we strongly believe that it is in the long run best interest of any company operating in the world today that if they don't understand and don't have good data on how they're using and impacting natural resource systems, they are going to face, and they're not working to make themselves more efficient in their use and impact of natural resource systems, which are, we all know, being depleted at a rate that we can't sustain. So we're having excess supply or impact on those systems because the economy is growing, and we need to find a way to be more efficient with those systems that are crucial to both human life and our economy. So companies that are leading the effort to become more sustainable are, in our viewpoint, structurally better prepared to thrive in the future. Mm-hmm. They're going to be more resilient, and they're going to be more successful. So we kind of take it as a fait accompli. If you are good at building a more efficient operating model around natural resources, you will generate better returns in the long run. but it's a long payback period. Putting up the money to do it up front is not going to pay back in the short term. And that's one of the bigger challenges we see companies facing, is that trade-off between short-termism and long-termism. Now, let me get back to what are we doing with that? How are we approaching that? And it really, again, it comes down company by company. I love giving an example. It's a very large Swiss pharmaceutical company. Again, we started the dialogue that we've owned for 10 years. We started the dialogue with them 10 years ago when we first invested, with a letter to the CEO explaining who we are, why we invested in the company, why we like their business model, and why we appreciate what they're trying to accomplish on the environmental side in terms of their environmental improvements. At the same time we send that letter, we also say, by the way, here's a couple of things you can do better. Our first engagement with them was that letter. Subsequently, we sent to all portfolio companies what our ideal disclosure would be for them in terms of environmental metrics, which, as you know, has evolved greatly over the years. And companies were often very confused about what does the market really want? And we just laid out what is the minimum we would expect from companies, and where are we going? Where do we see the best in class doing versus the minimum? And that included science-based targets at the time. And in 2017, we sent that out. And then we subsequently had a number of conversations with them over the years. The favorite part was we actually had a call with the IR, the sustainability team, and one of the legal counsel, to talk about why we thought science-based targets were the best thing. And they're like, we're a pharmaceutical company. We're scientists. We understand the environmental systems. We don't need to go through the science-based target process. We have our own metrics, and we're going to keep proceeding. And our answer was very simple. It's like, we appreciate that. We value you. But your drugs, you do all the research on your drugs, you still have to go through an FDA approval process and a regulatory approval. And the consumers want to see that, and the investors want to know that your drug has been gone through a protocol, and that we just want to expect the same thing for other things. You have auditors for your financial statements. You accept financial accounting systems. Why can't you? We need you to accept that there's a third-party entity that can help you set a commitment and validate your protocol, so we can have that belief in that, the credibility of that. They changed their mind. They went through the process. They committed to it, and they recently, actually last week, got validated.
Well, this is as we engaged you, I know our process took almost about 6 weeks that we were evaluating you and your colleagues, Tim. We came to the conclusion, much against my expectations, that a public equity manager, someone that's been in the business for more than a decade and generated in excess of 9% returns for their investors over that period, very much lived up to your mission, very much lived up to your sustainability mission, very much lived up to your impact mission. It has been a privilege, genuinely, to work with you and your colleagues and bring that message to the marketplace. I want to give you a closing opportunity. Anything else? Some other unique USP that you weren't able to mention? Is there anything that we missed in this interview that you would like people to know about Terra Alpha?
Well, thank you. I probably two things. One, I should have mentioned early on when I was talking about our team, because we have a great group of the 9 other people on our team besides me who bring a lot of credibility and knowledge and insight. That I really value, and they, this is not a Tim Dunn fund. It's Terra Alpha and the team. That also includes 8 incredible advisors that include 2 astronauts, one of whom was at one point the administrator of NASA, and the other who was chief scientist of NOAA, and then later the administrator of NOAA. We have a gentleman who was the climate advisor to President Clinton. We have several PhDs on the advisory board, and their role is really to help us think about the broad picture issues, the thematics, and the science behind the Earth analysis that is critical to how we think about our thematics and how we assess and characterize companies. So just want to mention that, just because I should have mentioned them earlier on. The other thing I would just mention is that maybe it's almost a shameless plug, but we're a very scalable investment strategy in public equities, and people always say, well, am I allowed to invest in your fund? Are you still open? We're always open. We have very liquid equity strategies. So I just put that in. I don't know if that will stay in the.
Yeah. Well, I think it will. I hope you found the process with IEL and IAS to be of value to you and your colleagues as well.
Oh yeah, I would love to talk about that for a second because I really valued the framework design that you created, and you also taught me some language that I hadn't really been thinking about in terms of how we're investing. And my favorite was the question about what is our counterfactual, and I think I've really kind of become a team around here. Everyone will say I'd say counterfactual all the time now because I really do value that point. It's like what would happen? What would have happened differently if we didn't exist? And I'm proud to say I think that there are some significant things that that we were part of helping cause that are different. And my goal is, to keep working to achieve our global goals. We're actually starting to see progress towards, over 40% of the companies in the portfolio have actually seen a reduction in their amount of greenhouse gas emissions. Mm-hmm. So it is possible as they've grown their business. So I think I want to emphasize that it is possible for us to achieve a more sustainable economy in terms of its impact on natural resource systems. It takes work, it takes commitment, and it takes both companies, but also their investors to support those companies.
Tim Dunn, CEO, CIO, Terra Alpha, been at it for a decade. It's been a privilege to have this time with you, Tim. You and your colleagues are clearly doing great work, both on the impact side as well as on the financial return side. That is why we invented IEL, so that funds like yours could get the visibility that they deserve. Thank you very much for your time today. Congratulations to you and your colleagues. And Tim, we're looking forward to following up on your future evaluations. And maybe if you launch a future fund, you're going to stick with public equities? Is that all you're going to do?
I think we'll stick with public equities.
Yeah, I think you're pretty. Thank you so much. Wonderful
to have
Terry.
you. Really appreciate it.
Wonderful to have you.